Welcome back to Smart Money. If you have been following the financial news, you would have been hearing Brexit this, Brexit that. Brexit is, if you haven't heard by now, the UK leaving the Euro Union. In the past week, most of the market volatility was due to this. Generally, anytime investors are unsure of how certain decisions will affect the financial markets, you can expect them to move their assets from riskier equities to bonds, precious metals, and cash. What does this mean to your portfolio? If you are invested in equities, your portfolio will take a dip. This is because when other investors sell, it lowers the relative value of your holdings, simply due to supply and demand. This supply and demand principle works for any type of investments, whether it's homes, baseball cards, or education. If very few homes are for sale, but a lot of people want to buy, this will result in relatively higher home prices and vice versa. If you collect baseball cards and you have a limited edition Babe Ruth card, it is worth relatively more than other cards because there are fewer cards than buyers. Now, if that card had a signed autograph, it would be worth even more since it makes it even rarer. The same goes for education or any particular skill set. Doctors, for example, are valued because they have to go through so many years of education and training to gain their knowledge. However, if everyone in the world was a doctor, that knowledge and skill set wouldn't be so valuable anymore since it is so common. Now, back to your portfolio. If you are holding a particular stock or asset class that everyone else is selling, all of a sudden, the market is flooded with a huge supply of that stock. And as more and more investors get desperate to sell, they lower the price they are willing to accept, thus pushing the price or value of your portfolio down. Therefore, you want to be able to sell or buy slightly before the majority of investors do so. Now, you most likely won't be able to act before the big pension funds or hedge funds, but you don't need to. You only need to beat the vast majority of other investors. The good news is, most other investors do not actively manage their portfolio. They just put their money there and wait for it to grow. That's almost the same as planting a garden and not watering, pruning, or weeding it. Sure, you have a garden, and yes, it will grow with natural rain and sunlight, but it will never be as beautiful as a garden that receives attention and care. Your portfolio is the same. Here's why. Today's economic climate has changed. It's no longer your parents' economic conditions where you can just leave your money passively in the market and it will grow. Looking long term, if you had invested your money in the broad S&P TSX Composite Index between September 5th in the year 2000 and August 31st in 2015, you would have made a gain of 25%. 25% sounds like a big number. However, we need to remember that this is over a 15-year period, meaning year over year, your money made an average return of 1.67%. Not exactly stellar returns. In fact, this is awful, as it doesn't even cover inflation. However, if your advisor had gotten you out of the market mid-July 2008, May 30th, 2011, and mid-July of last year, you would have made 25% between September in the year 2000 and mid-July 2008, another 50% between April 2009 and May 2011, and finally another 25% between June 2012 and July 2015. Significantly better returns than a passive advisor. The past year, the market has been moving sideways and recently broke downwards, meaning that you would have made no returns or lost money over the last year. Remember, your advisor's job is to actively oversee the growth of your money and take advantage of the upward and downward market swings. If your advisor is just throwing your money in and letting it sit, well, let's face it, you could have done the same. Your money would have done just as poorly or better if it was under your mattress. However, if your advisor took you out of the market to realize profits when the market was overbought, rather than sit passively and watch you lose your gains, you would have made substantial gains this year. The signs for the most recent market corrections and weaknesses was as clear as a slap in the face to those who understand how markets work. Next time you read or watch the news and there's a major financial or political move, ask yourself, how will this affect my portfolio? and then have that discussion with your advisor. Make sure there is a clear strategy to take advantage of the potential downturns or uptrends. Ensure that your advisor moves you to safer investments during downturns, and don't leave yourself exposed to this downturn. Investing is all about taking advantage of the growth and minimizing losses in times of risk. These are the people to whom you should be trusting your hard-earned money. Saving just $1,400 monthly with a modest return of 6.5% annually for 24 years will produce a total savings of just under $1 million, which is enough to fund a very comfortable retirement. Now the question we need to be asking, is your advisor good enough to give you those modest returns? We have already proven that in today's economic climate, a passive advisor most definitely is not. Time is a limited commodity. Don't allow your money to waste time, unless you and your advisor have agreed on a plan which have you working every day for the rest of your life. Your advisor should be advocating against portfolio losses rather than passively watching your portfolio shrink. If all your advisor does is throw your money into the market and watch from the sidelines, you might as well do it yourself. Make sure your advisor is an advisor and not just a salesperson selling you financial products. Having an advisor who understands today's volatile markets will work to your favor. Market timing and sector timing are valuable assets to have on your side if executed correctly. Obviously, you can't win them all. Not even the top fund managers are immune to the economic shifts. The knowledge and tools your advisor should possess are market, geographical, and sector timing, the ability to analyze long and short-term trends, a strong grasp of the macro interactions between countries and how they pertain to the economic cycles, currency, and commodity prices. Find an advisor who has the tools you need to realize your financial goals. In today's market conditions, timing the market is just as important as time in the market. Make sure you have an advisor that does both. Those who are adept will be able to preserve your capital, reduce losses, and maximize gains when the opportunity arises. Find a good advisor and let your money do the heavy lifting. That's all the time we have for today. Contact me at mitch@smartmoney.ca. That's mitch@smrtmoney.ca, or tweet me at @Mitchell Huynh. Thank you to all of our viewers, and see you next time on Smart Money on Rogers TV.